Hello and welcome to another Trades and Tutorials video. This is Jeff Fish, president of MarketGauge.com, and in this video I am going to show you how even in the madness of the markets that we've been having recently, high volatility, you can use something as simple as the first 30 minutes of the day to give you a really good idea as to which direction the market might take in any given day. So I'm going to look at the last week, which I would say has been anything but predictable. But when you look at the opening range, you may agree with me that it really, once you get the market going, gives you a good idea of which way the market wants to go. But before I get started, I want to make sure that if you're just finding this on YouTube, that you subscribe to our channel. And if you are not already familiar with marketgauge.com/tutorials, please go there and you'll find a whole bunch of other videos that will give you trading ideas, insight, and more. And of course, if you don't know, you can also see this video in HD by clicking on the little gear icon in the lower right hand corner. All right, so with that, let's get started. Now, I talk about the opening range a lot in this blog, and I'll put a link to a webinar perhaps on this page if you want to really get into it more. But for those of you who are just brand new to the idea, let me give you the 15-second what is the opening range definition. So the opening range, as I'm going to define it, is the first 30 minutes of the day. We're looking at the 5-minute charts on the SPY, and why don't I blow this up quickly? So on the SPYs, I'm looking at a 5-minute chart, and that means that after 6 bars, the first 30 minutes have been created, and I'm going to take the highest high of the first 30 minutes and the lowest low of the first 30 minutes, and that's going to be my opening range. Now, for the sake of this particular video, I'm going to focus on the very basic element of the opening range, which is when you are below the opening range, the market's in a bearish mode. When you're above the opening range, the market's in a bullish mode. Now, there are a number of different patterns and strategies for trading in and around these levels, but I'm just going to focus on a really powerful tactic that I usually just put towards the end of webinars when I do them occasionally, on how to use the opening range to predict which way the markets are, the general market's going to go, by looking at 3 or 4 of the major indexes all at the same time. The SPYs, the Qs, the IWMs, and the diamonds. Now, if you're trading E-minis, you can use this too. The idea, the concept is the same. Now, you'll also see on my chart here that I've got the previous day's high and the previous day's low marked. So these are really important levels, again, for some other strategies. Most notable, the one that I talk about when I say how to buy the low of the day. I always want to know where the high and the low of the prior day are as well. I'm not going to focus on them as much because, again, I want you to get the basic idea. So next week, when the Fed or everybody's driving the markets crazy over what the market's going to do, every single day you can come in, you can follow the markets with the opening range, and you'll just feel so much more in control in terms of determining whether or not the move that you're seeing is real or not likely to continue. So here's the key point. If you set up your charts the way I have them set up, so I have the SPYs here, the Qs here, the IWMs here, and the diamonds here. Look, you can put them in whatever order you want. The point is that I can see all of them at once. Now, you might also be saying, oh yeah, Jeff, but you've got these fancy lines. Well, you can either draw the lines in the first 30 minutes of the day, it's not hard, or just use a 30-minute chart, or what you really want to do and see with what I'm going to show you is a clear break of these levels so you can visualize it, especially when you see what I'm going to talk about. All right, so the next main point is you want all 4 or 3 of the 4 going in the same direction. If they're not, then that direction is not to be trusted. All right, now, as of recently, I've focused more on just looking at the SPYs, the Qs, and the IWMs and putting less weight on the diamonds because the volatility has made it much easier for the diamonds to be out of whack. And to keep this video short, I'm just going to focus on those three, but I'm going to leave the diamonds here because it's not like they're useless, and I want to show you that the true way to do it is to include them. All right, so let's just start with the SPY. Say that that's your index that you're focusing on. Now, in any given part in the market cycle, I will tend to follow or look for the leading index up or down. And so for right now, I'm just going to focus on the SPYs. In more advanced training, I'll talk about how to identify the one you should actually be looking at as the main one. Not that important right now for what I want to teach you. So if we use the SPY and say that's the main one, what happens? This is the first day of the week. It gaps higher after a long weekend, starts to run higher, and then your opening range is in place. All right. So after a gap higher, you want to be really cautious about a market that breaks below its opening range. Okay. You may not want to short it up there, but you may want to consider taking some profits, again, depending on where it falls in the context of the whole market. But look what happens. When the SPYs break down at about 10 o'clock, are the Qs breaking down? No, the Qs are holding. And the IWMs break on one bar and then never take out that bar. Look what happens as it continues. The SPYs break down further. The Qs are now below their opening range, but the IWMs are actually back into their opening range, right? So this is a major divergence. Doesn't take a lot of effort to see it once you know what to look for. And when you see a divergence like that, then if you think the SPYs are about ready to fall out of bed, chances are they're not. And if they are going to fall out of bed, then you want to see the one that isn't falling apart do it before you're sure it's going to happen. So in other words, no need to get head faked by the move lower here. The IWMs were telling you that the move lower probably wasn't going to happen. And even later in the day, when the Qs made a new low for the day, SPYs did not. IWMs were actually up above their opening range. All right, so what do you do with something like that? Well, if you're looking to buy a stock that's down or the market that's down, you can now look to buy the Qs on a reversal, or perhaps the SPYs on the reversal because they're a little stronger than the Qs. I show you how to do that in other videos. This one, I'm not going to focus on the actual signal, but the point is you want to focus on the fact that the market's not likely to break down and look up. Maybe you're not trading the specific index. This is your indication that you should go look at your favorite long ideas in individual stocks. Now's a good time to buy them. Of course, you could also focus on buying the strongest, the IWM, into the end of the day. All right, so the point here, first day of the week, could have been tough trying to figure out whether or not the market was going to hold or roll over at points, but now that you've seen how you can use the opening range, it won't be so tough next time, or at least so I hope. So let's go to the next day. I'm going to scroll forward so we can see the whole day here. All right, so the 9th, an even bigger gap high if I remember correctly. But today's outcome is a little bit different, isn't it? This time we gap higher and the SPYs make their way lower, not higher, as do all the other markets. They consolidate in their own way, some more than others near the opening range low, and then they break the opening range low. They all break the opening range low. That's what I mean by everything doing the same thing. All right, now once you break the opening range in a significant way, when you come back to the opening range, that should be resistance. So if you're thinking that the markets are recovering at this point, look at what's happening to the SPYs. Not even close to their opening range. And the ones that do get to their opening range roll over. Where do they roll over? Maybe you want to do something as simple as a little swing. And now you've got SPYs making a new low for the day, while IWMs are rolling over at their resistance level. Qs are rolling over at their resistance level, and actually Qs don't take long before they are breaking down to the new lows of the day. All right, so Under the opening range, remember, bears are in control. Bears were not only in control here, they were really pushing the SPYs lower. So 2 days in a row, market gaps higher, completely different outcome. Opening range guides you through both. All right, let's go to the next day. The 10th. All right, we don't gap higher today. We just kind of open unchanged, and we form a really nice opening range because you get a move up, a couple of bars establish the highs, and then you move back down and you consolidate at the bottom of your opening range. Now, look what happens though. In the SPYs, you poke through your opening range a little bit. You're sitting right on the low from the prior day, but the Qs don't get back to the low of the opening range, and the IWMs don't even get close to the low of their opening range. So if you're thinking over here that the SPYs are about ready to break down, then you're not looking at what's going on in the other two markets. And when the market starts to turn up, these explode through the opening range high. Right? Once they get through the opening range high in a big way, you can see the opening range high provides some support in the stronger ones. This one, which had been a little weaker, comes back into it, but then back above the opening range. And again, it's basically market in a bull mode for the majority of the day until latter part of the day the market trails off. All right. So if you were looking to get short, you're not getting short into a market that continues to go higher. All right. If you're looking to get long, you've got key areas, and you know that this is a good day to be looking for longs. Again, you may not be trading these particular indexes, but individual stocks, which will obviously benefit from what the overall market is doing. And finally, last day of the week, Friday, the 11th. And you know what I'll do? I'll let you look at this one for just a few seconds before I open my mouth and see if you see what I'm going to point out. All right, so this was a really nice day to catch on the upside if you could, right? Now, take a look again at the opening range low. SPYs take it out a little bit. Qs take it out a little bit. IWMs take it out a little bit, but they don't really follow through there, do they? Now the next time down, IWMs match the low of the day under the opening range. Qs kind of poking through it, but not nearly as much as the IWMs, and SPYs nowhere near it. All right. So when the markets start to turn around here, you know that they've head faked the people who aren't watching the opening range, and this is a good opportunity against the lows to look towards the upside. All right. Then what happens? They all break out at about the same time in a very convincing way. All right. So what do you do with this kind of information, right? You could be trading the individual indexes, but here's an example of what I did. So one of the stocks been on my watch list, and if you're a Triple Play member, you would know why. Not that one. Okay, so look at how you can take, and Apple worked the same way. AVGO was similar. These are all stocks that I got long today because of what I just showed you. I wasn't trading the individual indexes. I knew it was a good day to take a shot on some long stocks. Now, look at when AVG broke out. Sorry, not AVG, SRPT. Granted, this is a stock that looks really good on our triple play indicators. It's breaking out of a range. So it's got other stuff going for it. I'll bring that chart up for you in just a second. But from an intraday point of view, when I'm telling you that you should watch the opening range and see the markets turning, and then take that and apply it to an even stronger stock, this is how it works. So SPYs are now turning, all the markets are turning, IWMs are actually pushing near their opening range high, and my stock, the one I like, is breaking out of its opening range, right? So that was where I decided, you know what, I can take a really cheap shot at buying it here with a stop below the low of the day. For me, this is a swing trade entry. So I'm just hoping that it moves up. Bonus that it explodes higher at the end of the day. But I was able to get in because I had the confidence that the market was turning up. All right, I was able to hold as it pulled back because I had the confidence that the market was actually in a pretty bullish mode, and I knew this stock was now sitting on good support. All right, let's just take a quick look at Apple today. Now, I haven't been long Apple in quite a long time. All right, so by the time, let's say, when the markets were still under their opening range, Apple had already tempted its opening range high. Now, I wasn't looking at it there. I looked at it when it broke out with the rest of the market, knowing that it had already been much stronger. Again, if I move my cursor. So when the Qs pulled all the way back to their lows, when the IWMs pulled all the way back to their lows, Apple didn't even go close. And it was at that point that I decided, this could be a really cheap shot. If Apple makes a new high for the day, I can take a small risk. It shouldn't come back under the opening range high. And with any luck, it will break out through the prior day's high and move higher. And that's exactly what happened. All right. Now, you could say, well, yes, the whole market moved higher. And that's exactly my point. I wasn't buying Apple on days where I wasn't sure whether the market was going to go higher. I'm buying Apple when it makes sense because the rest of the market looks like it's going to go higher. So it all comes back to a really straightforward way to determine when markets that look like they're not are going lower might actually reverse, and vice versa, or markets that look like they're going to go higher and in fact they got a better chance that they will. Study the opening range. It doesn't take a lot of work. It just takes a little practice, and it does help when you know quite a few tricks, which of course we will show you in webinars, in really easy accessible training that's not very expensive. AM Trader is a great way to get started. I'll put a link to that at the bottom of this video. In the meantime, don't let the Fed drive you crazy. Enjoy the volatility. When you know how to trade it like this, it's a lot of fun. Hope that helps, and I'll see you in the next video.